The next model is the free cash flow valuation approach. So that's the third last approach we're going to learn this chapter for equity valuation. So first of all, we have to know what free cash flow is. Free cash flow is the cash flow by generating from using assets. So that's the money that we make actually in terms of cash flow. There are two different types of the free cash flow. First cash flow is the free cash flow for firm, which is just the, we don't care about the financing. We do care about just cash flow from using assets. So this one is the EBIT plus times 1 minus tax rate, the plus the depreciation. Okay, so the EBIT is earnings, right? And we basically have to pay tax, right? So it's a after tax EBIT plus depreciation, because depreciation is non-cash item. That's operating cash flow. And the next term is the capital expenditures, which is the expense for fixed asset, and minus increase in net working capital, which is about the current asset and current liabilities. So we can calculate the free cash flow for firm using this formula, and you can find the free cash flows. Now the next free cash flow is the only free cash flow to equity holders. We do care equity holders because they are the owners, and the equity holders cash flow is basically the full value of equity, right? So these are the one that we actually need to calculate. So free cash flow to equity holders is starting from free cash flow for the firm minus interest expense. So interest expense is basically the expense from the debt financing. So we pay to the debt holders, times 1 minus TC, the tax rate, because interest expense is tax deductible, plus increase in net debt. So the all cash flow about the debt holders just subtract, then we're gonna get the cash flow to equity holders. See, the idea is now the free cash flow for the firm, we compute the three factors like operations and the fixed asset and current asset and current liabilities, and then we subtract the cash flow to debt holders, we compute free cash flow to equity holders. Okay. Now let's look at this one. So how to find the firm value? We can find the firm value using the notion that the basically, first of all, we need to find certain terminal price. So it may be 10 years later, it may be 5 years later. It depends on how many years, really estimations, But suppose this PT is certain terminal value, then you can use the kind of same as the DDM formula, right? So D1 divided by K minus G. Now, instead of using dividend, because the dividend may not be very good proxies for the free cash flow, like the potential cash flow. The potential cash flow can be directly calculated by this free cash flow for the firm. We can certainly compute the free cash flow for the firm next period divided by, now K should be WACC. WACC is the weighted average cost of capital, which is weight of equity times cost of equity plus weight of preferred stock times cost of preferred stock plus weight of debt times cost of debt times 1 minus tax rate, right? That's the weighted average cost of capital. That's the overall cost of capital for the firm. So that should be the market capitalization rate minus growth rate. So eventually we need that growth rate. So probably first 10 years we can estimate, the cash flow, 5 to 10 years, using the free cash flow for firm formula. And then we can estimate the growth rate using the historical data, like the overall growth rate after 10 years or 5 years, terminal value, compute the price, estimated price, forecasted price as of that time. Then we can discount back to the present, everything back to the present, right? That will be the firm value. That's not equity value, that's firm value. That's whole asset value. So let's see the example. Suppose the free cash flow for the firm 1 million from year 1 to 4, then expected to grow at 3% after that. Assume WACC is 15%. Then our firm value may be computed by, first of all, price, say, the value of the firm is the price. Now that we can compute the price for using free cash flow for the firm 5 divided by WACC minus G, right? This one should be 1 million times 1 plus 3% divided by WACC is 15%, growth rate is 3%. Now the terminal value will be 8,583,333.33. So that's this one, right? Now we can compute, so now from year 1 to 4, so 1, 2, 3, 4. Now our free cash flow 1 million in each, then price 4, which is this one. Back to the present, everything. Back to the present. That's the firm value. The firm value will be 7,762,527.05. Now, because this is firm value, we need to get the equity value. So, if the number of shares outstanding 500,000, what predicted price of this stock, if firm has the 5 million of that. So, first of all, P0, which is the share price, will be now the value of the firm as of today minus, now we subtract the debt value because this is debt holders one. So you get this one will, the numerator will be the equity value divided by number of shares. Then you're gonna get $5.53. So this process called the DCF, discounted cash flow model. This is very useful when you evaluate actually the private equity, private firms, and also the takeover targets. So private equity firms usually very emphasize on this technique, DCF technique, because we don't have any price in public, right, in market. So to find right price to buy the private shares, we can evaluate from using this, or if we want to merge the firm, then you can use these techniques to find the real value of the firm. Okay, now let's use the free cash flow to equity holders. Now, instead of using the free cash flow for the firm, we can directly use the free cash flow to equity holders to find this value too. So instead of firm value, we calculate the market value of equity right now. Now, there's certain two differences. One, you have to use the free cash flow to equity holders. So this is direct equity value. Number two, your discount rate, the market capitalization rate, should be the cost of equity, not the WACC. WACC is overall cost. This is only the cost of equity because this is only about equity holders. So again, you find terminal value of the equity, back to the present, everything to the present, and add them up, then that will be the market value of the equity. So let's see this example again. Suppose free cash flow to equity holders is 900,000 from year 1 to 4, same thing, right? 3% growth rate, 18% equity value. Then what is the share price now? So you can have again P4 equals to, actually the equity value 4, so is free cash flow to equity holders 5 divided by KE minus G, right? And this one should be 900,000 times 1 plus 3% divided by 18% minus 3%. So if you calculate this, then you're gonna get the 6,180,000. So that's the value of the equity, market value of the equity. Now, when you compute, so now for 4 years, so $9,900,000. So 900,000 divided by 1.18 plus 900,000 again, second one 1.18 square, plus the third one 900,000 divided by 1.1 to the third, and the fourth one 900,000 plus this $6.18 million, right? Divide by 1.18 to the fourth, then you're gonna get 5,608,630.87. So that's the market value of the equity. Now, if there are 500 shares outstanding, simply you can, so you don't have to subtract, because now this is the value of the equity, right? So market value of the equity divided by 500 shares, and the share price will be 11.21. Okay, so that's the FCFE example. Different approach. We can use this spreadsheet. You can, basically the same things that we did. So if you're comparing valuation models, this is good approach. This it's very good approach, but one of the problems you may face is this DCF estimate is always somewhat imprecise. It's very hard to estimate. That's the biggest problem. So even though this is very popular, its value is very heavily relied on the techniques and like how skillful you are, basically, how high your skill is. So you need experience, you need good eyes, you need insight about the company, because everything should be estimated. So it's unlike PE ratio, this is kind of the things that you really need to practice, and you really need to get the experience, because this heavily depends on the your expertise. Okay. What about the forecasting the aggregate stock market? Aggregate stock market, you can expect the S&P 500, like U.S. stock market aggregate level, using the aggregate PE ratios, long-term interest rate, or sometimes using the aggregate, the DDM model, which is kind of interesting, because you can expect the market. And one of the things that you can do is this is the Treasury yield versus earnings yield, and there's certain relation between two using the data. Then you can estimate the earnings yield of the market, the aggregate market, U.S. market, using the interest rate data. So this is end of the chapter 13.